Alan, I want to go to the path from ultra-accommodative Stanley Fischer to accommodative to an unmeasurable neutrality, and to what Dominic Constam over at Mizuho calls super restrictive, which is basically disinflation, even with oil, even with rents. How close are we to restrictive? How close are we to super restrictive?
Great question, Tom, because I think you can't just look at this in terms of monetary policy. You have to look at it in terms of fiscal policy as well. And I think the most underrated element in terms of the policy stance is that fiscal policy from 2021 was really the most stimulus we've ever had by quantums. Yeah, I think had a 10% of GDP stimulus at that point for over those 2 years, about 5 times what a large stimulus is. That's still reverberating. That's still showing up in excess savings. That's still buffering the consumer. And to me, that is creating the underlying resilience. That means that interest rates can be much higher than they would otherwise be. Right. And that interest rates look like they're much tighter than they are.
An arch theme of your colleague David Folkert's Landau has been there will be fiscal stimulus, clearly in Europe, to rebuild Europe after an horrific war as well. Do you see fiscal leveling, fiscal stimulus, or maybe even some form of drop down in fiscal spending in America?
Look, I think a lot is going to hinge on Tuesday and the events thereof. I think the anticipation is that fiscal policy is going to be a lot tighter going forward. I think the question there again is what are we going to see in terms of front loading from the lame duck session in terms of the debt ceiling, how much constraint is that going to impose? But I think the anticipation will be that we will see tightening. But I again want to emphasize the fact that the lagged fiscal stimulus from 2020 and 2021 is still going to act as a buffer for 2023 and 2024. So it's still going to be substantive. And I'm not that worried about the tightening on the fiscal side.
Okay, but there's a very strange confluence of bad news is good news for markets right now. And we can put fiscal spending in there. It's good when we get bad data because that means yields will go down. It's good when we get less fiscal spending because it means bond yields will go down and perhaps it'll cap inflation. At what point does that run out and people start to think, okay, wait a second, this isn't going to support the economy, and that is negative broadly for the dollar and for risk assets?
Yeah, Lisa, I think if you look at past patterns whereby we've had a Democrat president with a divided Congress, you've seen, as you might expect, that fiscal deficits tend to come down. You see bond yields well supported, but you also see equities tend to underperform, and you see the underlying economy, the GDP numbers tend to be weaker. So I think you asked the right question there, that it does tend to add to underlying weakness, and that good news for the bond market is only going to filter through to some extent as far as the economy is concerned. I don't think it's going to be sufficient, for example, to stop a recession, say, by the time end of 2023 into 2024.
We had Ben Laidler on earlier in the show, earlier in this hour, and he was saying that he thinks that there's going to be a very big move up in risk assets because that there will be cutting of interest rates by the Federal Reserve. And we'll go back, not to the same extent, but to a similar playbook as the one that we've come accustomed to. Do you think that that is likely? Is that something that people can count on in the next 12 months or perhaps even 18 months, even if it doesn't seem like it's on the horizon now?
I think that's a very optimistic view. I think, we're trying to establish all the things that Powell highlighted, which was where's the peak and what is the shape of the rate cycle at the peak. And increasingly that peak just seems to drift up. We're now at a 5% handle. It's possible, and I think the skew is still to the top side of that. We're thinking in terms of the shape, and people felt the higher we got, the quicker rates would actually come down. In fact, now increasingly there's a feeling that rates won't come down quickly, that it's more like an inverted L at the top of the cycle. So to me, none of that is that optimistic from necessarily from a growth cycle standpoint.
Alan, if we dash to $100 Brent again, is the $100 a barrel Brent, if we see it now at $98, is it the same as $100 the last time around?
I think you've always got to, just assess what the overall backdrop, macro backdrop is. I mean, I think it would be upsetting from a sort of a stagflation standpoint if we start to see oil prices move in the so-called sort of wrong direction from a stagflation standpoint. I think falling on a weakening economy, one would argue that perhaps it'd have even more negative effect than it would have had, in prior last few quarters.
Alan, a general question here. Let's call it Econ 101 this morning. I believe there are 14 core CPI measurements in each country. Is there a value to looking at headline inflation now, or do each of us have to find a core series we're comfortable with?
But I think core was seen as helpful in terms of telling you what the underlying picture was, where the natural gravitation would be over, say, a 12-month period when food and energy prices, erratic food and energy prices, work their way out. But I think if you're asking questions about, what is inflation doing for the average man in the street, then skip the core. I mean, you've really got to focus on the total inflation, and it would be a travesty really to start removing food and energy from those kind of measures. But I think core for the economists trying to look, say, 12 months out is still reasonable, and you've got to search country by country, I'm afraid, Tom.
When you look country to country, I just want to wrap it up with this question about Europe. And we've been talking a lot about the U.S. and the fiscal spending in the U.S. and how we're going to see the dollar progress. But at what point does Europe become attractive again, considering how much it sold off, but also considering that it faces a much bleaker picture in many ways than the United States?
Yeah, I mean, obviously a lot turns on the politics. So you had somewhat optimistic mentions of the US touching base with the Russians, which is, I think going to egg people to think in terms of some sort of Ukraine peace deal eventually. That's obviously an optimistic view of things. So that's going to be crucial, I think, in terms of how you think about Europe going forward. That being said, I think there is some built-in resilience that we're starting to see from the economies. You are seeing an ability to navigate some of the energy shocks. So I don't think it's all pessimism, really, in a way. But I think you're still going to have to just wait for that political signal before there's a real buying opportunity.